Welcome to The Fine Print with Lisa Pflugh, a podcast for people navigating life, money, and real estate during some of life's most important transitions. If you own a home, have aging parents who do, are thinking about buying or selling, or just trying to protect what you've built, this podcast is for you. Each episode brings you clear, real-world guidance from trusted pros, attorneys, lenders, title closers, inspectors, with real stories from people who've been there. We'll shine a light on some of the common mistakes others have made so you don't have to repeat them. And we educate you so you can become the expert in your own journey. I'm Lisa Pflugh, Colorado Springs realtor, with years of hands-on experience helping people make smart, informed decisions about real estate. Let's get into the fine print. Because in real estate and in life, the details matter. So welcome to this episode. Let's talk loans with a lender. So in this episode, Lisa Gaimara and I are going to discuss the fine prints of loans and lending and give you some insight, some pitfalls to avoid, and a plan of action as you get your finances in order and get ready to buy a home. So welcome, Lisa.
Thank you for
coming.
having me.
So I'd like to welcome Lisa Gaimara. She's a loan officer with Supreme Lending. You have over 30 years of experience in loans in the lending world. The first 20 in underwriting, the last 9 in sales, being a loan officer. Mm-hmm. And you've earned President's Club, meaning you've been one of the top producers in your company 6 out of the last 9 years.
Yes.
So congratulations.
Very exciting. Thank you.
So Lisa and I have worked together helping over 50 families. We have become the dynamic duo known as Lisa Lender and Lisa Realtor. That's how people can keep us apart.
That's how we answer our phones sometimes too.
Okay, so let's start with just kind of tell me, what is your favorite part about being a loan officer?
My favorite part about being a loan officer is helping walk through the process with the client, with the buyer, whether it's their first time ever buying. Getting to know them on a personal level is one of my favorite things. I'm one that we end up becoming really good friends by the end of the transaction. Yeah. And then also creating those peer relationships with realtors like yourself, where we become friends and family, and we work together to navigate behind the scenes for the clients. I love doing that.
For sure. That's great. Okay, so let's jump right in, and we're going to talk about some misconceptions and mindset. So a lot of people feel like they have to be perfect to buy a loan, to get a loan. But that's not necessarily true. So let's talk about that. So let's talk about the first one, the 20% down myth.
Yes, it definitely is what we call a mortgage myth. A lot of people come to us saying, "Hey, I don't have the 20% down. My grandmother tells me when she bought a house, she had to put 20% down." And you don't have to have that. There's definitely loan terms and programs out there that you can put as little as 3% down, all the way down to more than 20% if you'd like. So it's just navigating that for the customer. Yeah.
Another one that we hear a lot is they're afraid my credit's not perfect. Mm-hmm. So, I don't even think I can buy a house.
Yeah.
So how do you handle that one?
We have tools, and it's definitely, I encourage everyone to do a pre-application just to see where you are, where you start out at. There's a lot of credit apps that people use that show what their credit scores are.
Are you talking like Credit Karma?
Yeah. Okay. Yeah. The Credit Karmas of the world.
Yeah.
But those aren't your mortgage credit scores. Your mortgage credit scores could be different. And so if you're following your credit path on those apps, it might not be the right score for a mortgage. And it might be, some people are pleasantly surprised when I do the pre-approval and they're like, "Whoa, I thought my credit score was lower than that." Kind of a thing. So
so what they don't know, they think they're doing the right thing, but they could actually be doing the wrong thing.
Right.
For if their goal is to buy a home.
Right.
So one of the things that I hear a lot of is that they're afraid to talk to a lender because it's going to hurt their credit. Because if they think their credit's kind of borderline, they don't know, they don't want to take a chance.
Yeah.
So talk about that.
So at Supreme Lending, we do a pre-application, and it's called a soft pull. So we consider it a no-ding credit pull. Okay. And what it does is it gives us a baseline to start off with, and it does not create a credit inquiry on their credit report. So it doesn't impact their credit at all. We just are able to see what their debts are, where their credit scores are, that kind of thing, and get them started on. And then if they need some credit help, I can do a credit simulator to kind of get the ball rolling and getting them moving.
So a credit simulator is obviously what it sounds like. It's a simulation that you can kind of run some parameters through and say, if you did X, Y, and Z, you would be ready in this amount of time to have your credit score where it be where you need to be and your debt to be where you need to be in order to buy a house and get a great deal. Okay, awesome.
And the credit apps out there do have the same type of simulator, but I detour away from that because, again, the credit apps out there aren't the same as your mortgage credit score.
Yeah.
And so sometimes those credit apps will tell you to do, hey, if you pay off your car early, your credit score will do this. Whereas on our side of it, we look at it as if you pay off your car early, it might actually hurt your credit score because that's a good standing installment loan that's being reported.
So I think it's a really good point about it's the difference of using AI or Google versus talking to a person.
Right.
And you've got intimate knowledge and understanding where with AI and Google, if you don't input the right information, you're going to get the wrong output out. And at least with talking with you, someone can kind of give you all the scenarios and you've got the years of experience to kind of work it through with them and really help guide them in the right direction.
Yeah, absolutely.
That's great.
Yeah.
So what are some other no. I've got another one. I don't want to skip ahead. Yes.
Yeah.
Okay. So what about someone that says, I'm just going to go online and find a lender?
Yeah.
I feel the same way. Yeah. It's
The challenge with that is online lenders, I don't think have the availability as much as a local lender would be.
Availability to be to reach out and talk
exactly,
to them? Okay.
Yeah. Sometimes you have to call into a call center. You don't have, I give my personal cell phone number out. I'm available text, email, video call, Zoom, whatever they need to make that connection. And I think that's the biggest thing. The other thing too is, I hate to use this phrase, but the only way I can explain it is garbage in, garbage out. Sometimes when you fill out an online application, there's certain questions that as I'm going through your application that I'll lead more into to see if there's additional income that we need to use, or maybe there's something on credit that is not on the credit report that we need to see that could impact your applying or qualifying down the road. So I online lenders, the other pocket is interest rates can vary. And so talking through that with you on the phone and having someone that is there, not just an 8 to 5 type situation or a call center, because I would say in our experience working together with clients and working, most of our stuff happens after 5 p.m.
It sure does.
Or on the weekend, right?
Right.
When we can get a hold of the buyers when they got home from work and they finished dinner and they sit down and they start reading through text messages or voicemails and they realize, oh no, this popped up. They can't get a hold of somebody if you use an online lender.
Yeah, well, and then also just on the personal side, your phone's going to blow up.
Right.
Because as soon as you apply something like that online or fill out a form, they sell your information and wham, you're getting phone calls and you're just,
bombarded.
Yeah, it's just ridiculous. Yeah. So here's a myth that I often run into when I'm doing open houses is they think, well, I'll just look for houses first and then I'll find a lender once I find the house that I want.
Yeah.
Obviously, this market is very different than we were 4 years ago where you couldn't even breathe. After you found the house you wanted, you had to move quickly. But, now when we have some more time, home, days on market are a little bit longer. So we have some choices. But still, is that a good idea?
I don't think so because there's a lot that goes into pre-qualifying for a home loan. There's a lot of things that we look at, a lot of numbers that we run, different scenarios. We could find more income. We could find less income. All of the things that go into that little black box of that approval.
Yeah.
And the challenge with that is if you're going out and looking at $500,000 homes and you finally, get that pre-approval and you have to look at $400,000 homes. It's a tough thing for you to step back on and say, hey, wait, hold on a second.
Yeah.
And on the flip side, you're looking at $350,000 homes and you actually qualify for $500,000 homes. And we can look at what that payment would do for you and your home, your household and your family.
Because that's also,
it could go the other direction
that's
too.
Another important thing too is what you qualify for and what you're comfortable with in your mortgage payments. That's another reason to not use an online lender, because they're going to say you qualify for this and you might not be comfortable with that payment.
Right.
People, the saying you don't want to be house poor.
Yeah.
And so it's really good to work with somebody who understands your situation and
personally.
Yeah, for sure. So what are there any other misconceptions that you hear that I don't hear because when they talk to you directly that you're hearing?
Absolutely. People will come to us and say, hey, I don't have any money. I know that I need that 3% down or that 3.5% down. And then we start dialoguing and talking through that. And maybe they qualify for like a first-time home buyer program that assists with the down payment.
Yeah.
And like you said, the market's different right now. So we've been able to get the seller to help contribute towards closing costs and those kind of things.
Yeah.
So there's definitely some avenues. I think that's one.
Yeah.
And then just kind of talking through credit. I think credit and assets are a huge piece to the home buying process.
Yeah, for sure.
Yeah.
Yep. Can you share a story of a buyer who didn't think they could buy, but after talking with you, realized they could?
Yeah, I actually have a recent success story with this. I had a cute little family come to me. It was 3 adults in the home and 2 younger children. And they came to me and said, hey, we've been through 3 different lenders. We've tried to get pre-approved. My husband and I, they say we just don't qualify. And so I kind of thought outside the box. And I think that's where my underwriting comes in. I think outside the box ahead of the game instead of behind the game. And I sit there and we were able to put the adult son on the loan because he was employed and had a full-time job and still living at home. And so it closed with the dad and the son, and they were first-time home buyers. And he was 19 years old.
That's awesome.
And he got to buy a home and be a part of it for him and his family. And
that's the beginning step of wealth building, right?
I'm getting goosebumps just thinking of it. It was very heartwarming for sure. Yeah.
Okay, so let's kind of transition a little bit and talk about how do lenders actually look at you? So, the things that you need to be aware of when you're talking to a lender, it's like your credit score, your FICO score, your debt, the amount of debt you have, the income that you have, your job history. So let's talk about that.
Yeah, there's really 4 main things that we look at when we're pre-qualifying someone. It's going to be your employment history, obviously the income piece that goes with that, where the money's coming from for down payment, and then your credit.
So let's take a little caveat. Where can the money come from? For a down payment?
There's several different sources. You can get it from just a regular checking or savings account. Right now, a lot of this has actually happened since COVID. A lot of your 401ks, if you have a retirement account, you can actually take out a loan against yourself. It's basically you're borrowing against yourself. You pay it back pre-taxed, and they give you a reduced interest rate if it's your primary residence. So that's kind of a cool thing. Any kind of stocks or IRAs or anything like that, we can actually use stocks and IRAs sometimes as income versus cash to close. Gift funds. The challenge, and I think this might be coming up a little bit later, is the mattress money, which we'll talk about. We will talk about that, where that's a little bit more challenging, but you can, a family member wants to give you a gift, or you and your fiance are getting married and they want to contribute towards your house. We can do that. So,
okay. Awesome.
Definitely different avenues.
So we talked about that. So something too that I want to, people will hear, it's the debt to income ratio. So talk about that.
Yeah. So most programs have a housing ratio, and then they have a debt to income ratio. The housing ratio is whatever your new house payment is going to be against your gross income, not net gross income.
Okay.
So that's usually runs between, we can do 29% all the way up to 45%, depending on their credit score, down payment.
Okay.
Various different things go into that. And then there's your debt to income. And the debt to income is typically whatever reports to credit.
Okay.
Your new housing payment against your gross income.
So all like your car payments, student loans, all of that kind of stuff.
But there are some caveats where we get bank statements and we see that somebody went to maybe a car dealership that doesn't report to credit, but we catch that payment on their bank statement coming out, because we ask for 2 months bank statements on most products.
Okay.
And so we see that come out, that the underwriter will ask. And that's where, again, my underwriting, I look at the bank statements, or if there's something that comes out of their pay stubs before pre-taxed. There are some companies that will allow them to pay their car payments or pay a debt through a pay stub before pre-tax. There's some different things that come into play. Well, that'll get caught in underwriting.
Okay.
So we need to kind of look at that up front. Yeah.
Gotcha. So what about student loans? Talk about that, because a lot of people have student loans.
Yeah, student loans. If you do have student loans, either if they're yours and or a family member's, if it's a deferred student loan, we still have to calculate an estimated payment because it's not going to be deferred forever.
Right.
Yeah. If someone has a student loan and you've helped them apply for it, but they're making the payments, we do have the ability to exclude that from your debt to income ratio, depending on documentation. So even if it has a zero payment and you're not making a payment, we still have to take it in consideration.
Gotcha.
An estimated payment.
Okay. So when you and an underwriter are looking at an application, what matters? Is there something what matters most?
Yeah. Again, it's back to those four things: your employment, your income. Employment history is a big, big thing. It's 2 years employment history. And we have had gaps where, someone has had maternity leave and they had a baby and then they decide to go back to work.
Yeah.
We can still do that. You don't have to be on the same job for 2 years, but we still have to prove a 2-year work history, but we can go back sometimes before the maternity leave started. So there's some creativity there.
So if you have somebody that, I don't know, let's say they were in the military, they got out of the military, now they're in a civilian job. Is that cause problems?
No.
Okay.
Yeah. No. Great. As long as there's a consistent employment history there.
Okay.
And then again, income, looking at that income piece. And one of the things that we'll, I think, talk about a little bit is that job change and where that consistency of the income is coming from. And then, again, assets. Where's that money coming for closing? And then credit.
Okay.
Yeah, those are the 4 top things.
So have you ever had someone withhold information because they maybe didn't think it was important or just thought it was none of your business or didn't know it was important?
Yeah.
So talk about that.
I think a lot of times, and the 30 years that I've been in, at least with the 9 years I've been in sales, I don't think anyone has ever purposely kept information. I think it's just something that they don't think it's important or it didn't come up, right?
Yeah.
And then it comes up later.
Yeah.
And I tell people I'm like their loan therapist, right? You want to tell me the whole picture up front, and then we navigate through that because we have so many checks and balances on the backside of loans now. Just with the change that with the CFPB and the re-verifying and the verifying and all
which
the
is
things.
a good thing.
Yes, absolutely. One of the things that we do is it will pop up at some point.
Yeah.
But when it does, we figure it out.
Yeah.
We navigate through that together.
Yeah.
And that's where it's beneficial to use a lender that will answer their phone all the time.
Yeah.
Yeah. And navigate through those because people lose sleep over it.
Right.
And this is one of the biggest financial
because
decisions.
it's important to them. They're thinking about it all the time.
100%.
And so we have to be available to help them through that.
Yeah.
So what if someone is self-employed? We've got a lot of entrepreneurs that still want to buy a house. Does that pose challenges? Is it possible?
It's definitely possible. So self-employment is my jam. When I would when I was in the underwriting world, I actually did a loan for someone that owned 21 different franchises, and they were different types of businesses, sandwich shops, a tire shop, whatever it might be.
Yeah.
He owned them all, and I loved it. And people would run as fast as they can away from 21 different tax returns.
Right.
But I that's my jam, and I navigate through that. We also have different programs now available that we didn't before, like a bank statement loan. We do have some investors that will do 1 year tax returns. We have a P&L loan that we can work off of. So there's definitely some different options that we have for self-employed right now.
Well, that's good to know. So being self-employed doesn't eliminate you from being able to buy a house, which is great. Good.
Yeah.
Okay. So let's talk. We've talked a lot about getting ready for loans, but let's talk about the different loan types because there's, that can be overwhelming.
Yeah.
Do people need to know, like when they call you, do they need to say, I want this kind of loan?
No.
Okay.
No,
good.
absolutely not. We do have buyers that come to us and say, hey, I've done my research. I want to do a conventional 20% down loan because I think that's the best for me, which I completely will go that direction with it. But then I also give them a couple of other different options because a lot of people think, too, that the FHA loan, which is the government-backed loan, is for first-time home buyers only. And it's not.
Yeah.
It's not. And so sometimes, a conventional loan is better for them, and sometimes an FHA loan. And then we've got the VA loan. Sometimes I have veterans that come to me that they're putting 20% down and they don't realize that a VA loan still would be beneficial to them.
Yeah.
Not having to go straight
they hear something on the news or there's a stigma with it or with something for some reason.
Yeah. Or auntie, bought a house 20 years ago and she's like, oh, I would never do that kind of loan. But yet it ended up being the perfect loan for them and their family.
So let's kind of talk about pros and cons, just as a broad overview. So what are some pros and cons of conventional loans?
I think the pros obviously is if you're putting 20% down, you don't have to pay the private mortgage insurance. Whereas on the FHA loan, you do, regardless of what your down payment is. Sometimes on a conventional loan, it could have a better interest rate if you don't put 20% down.
Yeah, that's something that is surprising a lot of people.
Yeah. The investor likes that private mortgage insurance and have that backing on there.
So what you mean is whenever you don't put 20% down, you automatically, the bank will put the private mortgage insurance
Correct.
on there to insure the loan.
Right.
And so because that's giving them, it's a safer loan for the bank, they will give you a better interest rate.
Interest rate, yeah. So that would be, I would say probably the cons of a conventional loan are the debt to income ratio is lower than an FHA loan. So if you've got a buyer that wants to stretch their budget, we tend to go towards the FHA a little bit more because we can go all the way up sometimes to a 55 on a government loan.
55% ratio.
Debt to income ratio. Yeah. So,
something that's interesting too, the loan limits.
Yes.
So with some different types of loans, there are loan limits. And so with conventional, are there loan limits on that one?
Yeah, there are. And they change annually. So every November, they'll come out with new loan limits for the following. So it's Fannie Mae, Freddie Mac. They basically take the nationwide average of, well, I wouldn't say nationwide.
It's usually county.
State. Yeah, it's usually county, state to state.
Yeah.
They take that average and then they say, okay, we're going to give you, $15,000 more. And sometimes it could be $60,000 more. We just don't know. It just depends on where the market is at.
Yeah.
And those loan limits actually follow, they're standard across the state. So every county in Colorado will have the same state. It's where you get into what we call the high balance or the jumbo, that number changes per county. But on FHA will, most of the Denver metro counties have the same loan limit, but then you get into like El Paso
County, that's different.
Yes, or like Douglas County is different than El Paso, even though
they right next to each other.
You could stand on one side of the street and be able to buy an $800,000 home with FHA, but then you step on the other side of the street and you're in El Paso County, and it's a little bit different.
And it's the loan limit is the amount that the loan can be. So if you had a $600,000 house but a $500,000 loan limit, your loan could only be $500,000. So
it changes the qualifying for sure.
Yeah. So let's talk about FHA. What are some benefits of FHA?
So FHA, the rates are a little bit more competitive, especially if you have a lower credit score.
And that's because with FHA you have private mortgage insurance.
Correct.
So
yes.
It's
So with FHA you do pay an upfront mortgage insurance, which is financed into the loan, and then you also pay a monthly mortgage insurance.
So the upfront one is part of your closing costs.
Correct.
And then the monthly one is part of your mortgage payment.
Yes. And on the upfront mortgage insurance on FHA, you can elect to pay it in cash, but you can finance it. And I would say 98% of the loans that I've ever done,
they just finance
it in. Yeah. The pros and cons of FHA is one, the mortgage insurance. You'll pay it regardless of what your down payment is, and then it stays on the loan for 15 years, up to 15 years.
Okay.
If you refinance out of it and go to a conventional loan, then obviously
it goes away.
Yeah, as long as you're below that 80% on the conventional loan.
So talk about that real quick, because I don't think we talked about that.
Yeah, your 80% loan to value is where that private mortgage insurance cuts on conventional.
So when your loan is worth 80% of the value of your home, then you can talk to the lender and say, hey, my value's there, let's get rid of that.
Exactly. Yeah. You can petition to get rid of it. And then on the FHA, again, it's that debt to income ratio where we can kind of stretch it just a little bit more if if they find the perfect home and they find out there's an HOA on it. And you're like, oh no, I want to do an HOA. I want this house, but now my debt to income ratio is over the conventional loan limits, then we may look at going FHA.
Yeah. And just a little aside, the appraisals are different on conventional loans and FHA and VA loans. So I know from the real estate side, an appraiser for an FHA or a VA loan is going to go in the house, and they're going to go in the attic, and they're going to go in the basement, and they're going to kind of not do an inspection, but kind of do an inspection. Right. Like they are walking around, they are looking for things. They're there to protect the buyer.
Correct.
And so that may be something to keep in mind. If for example, I have a story where I had some clients that we were approved for conventional, and we found a house, but the house needed to be painted.
Yeah.
And we had talked with the seller, and we knew the seller was not going to paint the house as a part of the inspection. And so I talked to them because I know that for an FHA appraisal, they look for peeling paint.
Right.
And if there's peeling paint, it will come back and say, we'll appraise it at this value as long as this condition is met, meaning the house had to be painted. And so I had them talk to you, and I said, talk to her about an FHA loan, run through all the scenarios, see if that, all the financial parts work. Because if we go and switch it to FHA, we can get them to paint the house without, and that's what happened.
Yeah.
And
I think in that instance too, if I remember correctly, you submitted the contract as eligible for conventional or FHA financing.
Or I did for both. Yeah.
And which was great because they ended up getting a better interest rate on the FHA too. So that's where one of those pros is depending on where they fall. I will tell you on conventional, sometimes if you put down a large down payment, we don't even have to do an appraisal at all. And it's always up to the buyer discretion. We could get what we call a property valuation waiver where you don't need an appraisal, but I always have that conversation with the consumer and say, hey, you don't have to do an appraisal, but if you want to know that you're paying market value for this property, we can do an appraisal, but then it becomes part of the loan. So we have those conversations.
Yeah, that's great. And that's not an option with FHA. Because it's government backed,
Correct.
They have to have the appraisal.
Mm-hmm.
So let's talk about the VA. So VA is specifically for our veterans, people that have served, and so we're so grateful for their service. And this is one of the benefits of having served. Yeah. So talk about that.
So VA, you can do 100% financing, and there is no loan limit for a VA. So you could buy a $3 million home. On a VA loan. There's no mortgage insurance paid.
Nice.
Depending on their status with the VA, they could be eligible to be excluded from paying what we call the funding fee, which is the fee that is charged on VA loans, but depending on where their disability lays or whatever their percentages, they may be exempt from that.
Nice.
And so I do all that homework up front too as well. I pull some documentation from the VA just to make sure we've got all of our I's dotted and T's crossed before we start looking at homes.
Yeah.
And again, VA is one that doesn't technically have a debt to income ratio at all. So depending on the dynamic of the veteran, the credit score, down payment, if they are putting one down, maybe reserves. And what reserves are is money that sits in an account after closing. So like checking, savings, retirement account. They may have money in the bank that if something were to happen and they would not be able to make their house payment that month, they can pull from that account. So that's a big piece of that, stretching that debt to income ratio.
Okay. And then jumbo loans talk about that.
So jumbo loans are anything over the conforming loan limit.
And the conforming loan limit is the thing that we talked about where it's like the ceiling that they can't go above.
Right. Okay. And then those county limits, that we talked a little bit about, that becomes a high balance conventional loan. Then anything over that high balance becomes a jumbo. And the jumbo investors, we do have delegated underwriting at Supreme Lending, so we do a lot of the loans are all kept in-house. We don't really worry about having to send them out. But the guidelines are a little bit more stricter. You are asking for money. We're handing you $1 million in a loan amount.
Right.
So we want to make sure that you meet all of the expectations that the lender
Yeah. So there's lots of options out there for people. And really, it's just kind of good to give you a call and kind of talk through, like, what are my options? Educate them. Yeah. And that's something that is different, I think, that you do than like a call center would not do. They're not going to educate you. They're going to go, oh, you want a conventional loan? Okay. And, you might think that's the best thing on earth, but something else might be better for you, and you won't know it until you talk through it.
And we do have what we call non-QM loans that kind of pop up, where maybe you have an investor that wants to come in and they want to buy their first investment property and they own another home. We actually have programs that you don't even have to own another home, but we use the rental income of that investment property to qualify them versus their W-2 or maybe their self-employment income. I mean, we have all options. We have bridge loans. I do reverse mortgages now.
Oh, okay.
So we definitely have
That's a whole nother podcast.
And whole is another. But there's so much out there that if you're talking to me on the phone, I'm going to dabble into all those little pieces and give you the information versus a call center where you call in and they go, nope, we don't do those.
Right. Yeah. Okay. So let's talk about landmines because they're out there. How do people accidentally sabotage themselves?
Accidentally sabotaging. So I have the same conversation with every buyer when we get through the pre-qualification process, and that pre-application is don't go out and buy a new car. It'll look really beautiful in your new garage in your new home, but it could horribly affect you. Yeah. Same thing with people that, they're going maybe from an apartment to a new home and they need a new couch. And, the furniture store has no payments, no interest for 12 months or whatever.
Right.
That does affect your credit still. It's still applying for new credit. And again, falling back on, we have to estimate that payment regardless of whether or not. And I think that's one of those things that maybe consumers don't know that they're doing it because I don't have to make a payment, so it doesn't count in my qualifying. It does. So you want to be just very careful. But there's also that extreme that I had a an older lady that every time she'd go to the grocery store, she would call me and she's like, can I put my groceries on my credit card? So yes, you can still go and get groceries. It's okay.
Yeah,
but
it's just the things like you don't want to buy a new washer and dryer that you're going to put in your house, or appliances, or a new car.
Yeah.
You have a very boring financial life.
Just for like 30 to 45 days.
Right,
that's all we're asking. Yeah. Yeah.
Okay. So what are your top please don't do this stories?
Please don't go out and buy a new car. Please don't get mad and quit your job.
Oh, yes.
Don't quit your job in the middle of the transaction because that could end badly. We do what we call a soft pull LQI, which it's called, at right before closing, and then we also re-verify employment right before closing, and that's stemming really off of COVID and all the changes that happened during COVID with employment. So we do re-verify everything right before closing. So you just, if you are going to look at getting a new job or something like that, just
have your start date after your close date.
Yeah, or call me because I never want to hold someone back from making it better for their lifestyle and their family.
Right.
So, but it's all about conversation.
Yeah. So let's talk about, we mentioned earlier, mattress money. So what is mattress money, and big cash deposits into your accounts, and
mattress money. So mattress money has been around for a while. There are some people out there that just don't believe in banking. They don't want to have their money in the bank. They want to have accessibility to it, and they're cash buyers, right? So they're ones that pay cash for everything. They don't want to put anything on credit because they don't want to have debt.
Yeah.
And so we can kind of navigate through those, but it's a challenge to document where the cash is coming from unless it makes sense for the buyer. So when I say that, like someone that's a waiter or a waitress works at a restaurant and gets tips, it might make sense for them to have a very big tip jar saved at home versus putting that money in the bank. So there are some exclusions to that rule, but it's a lot more documentation and paperwork that we have to go through.
Yeah.
So if grandma decides to give you, $3,000 out of her, her safe at home to say, hey, here's money for you for your house. I hear you're shopping. Yeah. And that gets put into the bank and we see that deposit. We're going to ask where that money came from. And so that's where it gets a little bit more challenging to document.
And that's to prevent money laundering.
Yep.
So there's a good reason for it. It's a little inconvenient at times, but it's really nice if you have a grandma that will give you big cash money.
Yes, absolutely.
So during the loan process, again, live a boring life.
Yes.
Don't do anything spectacular.
But you can still go to the grocery store.
Yes, you can still shop.
Yeah.
So let's talk about your payments, because we kind of talked about a little bit earlier, but what's in your mortgage payment? What does that entail?
Yeah. So you've got your principal and interest payment, which is your payment, the mortgage loan against the interest rate and then the interest there. Then you've got your property taxes, which are property taxes and homeowners insurance are specific to the property.
Okay.
So you've got some communities that they roll their homeowners association into their property taxes and some that don't.
Right.
You've got some that have two HOAs that we find out later on. They're like, oh, shoot, there's a second one.
And
that's
a metro district.
Well, and that's what I love about working with you. You do a lot of that research up front and you communicate that to me because sometimes an additional $35 payment a month, if we're stretching the buyer's ratios, it could cause a problem. Yeah. So you've got your principal and interest, you've got your homeowner's insurance, hazard insurance, unfortunately, has gone up like everything else right now. Yeah. Wind and hail is a big thing. And so it is property specific, it is location specific as to how much their homeowner's insurance is going to cost them. And then you've got your private and mortgage insurance if you don't put that 20% down or go FHA, and then your homeowner's.
Yes. Yeah. Okay.
Yeah.
So all of that, and a lot of times on those online calculators, they're only calculating principal and interest.
Correct.
And they're not, and that's leaving a big chunk, especially with the price of insurance now, it's leaving a big chunk. So there, if you go online, you're thinking, oh, I qualify for $600,000. And then the reality happens when you haven't been counting it all in.
It could increase your payment by $1,500 a month, depending on where everything lays.
Yeah.
So you want to definitely, reach out. And that's the one thing that you and I work together doing is once we've gone through that pre-qualification, they're given a purchase point range that they can go play in.
Yeah.
And then if I know you're taking them out on a Saturday or a Friday afternoon or a Wednesday morning, I've got that laptop in tow with me and I'm running payments for you. Because there might be that house that's at $550 that they just love, but the property taxes are cheaper. So it does fall within their budget and they can make it happen.
So, okay, so let's talk about closing costs versus down payment, because I think a lot of people are confused. And also we'll talk about the pre-money that you need. Right. So there's kind of a lot involved that
Yeah.
people just don't realize.
So right off the bat, I tell people when, I'm in casual conversation with somebody like, well, how much does it cost to buy a house? I'm not one that just says, oh, you just need 3%, because I know that's not true. So I tell people in general, you need about 7%. And that number includes down payments and closing costs. Because right now, closing costs are running you about 3.5% to 4% of whatever your loan amount. And what's included in those closing costs are any third-party fees that you're going to pay. So it includes the lender fees. It includes creating what we call an escrow account, which is an account that we put aside to pay your taxes and insurance for you through your payment.
So your mortgage
you don't
payment,
have to worry about it
Yep,
going
your mortgage
forward.
payment, you pay it, and then taxes and insurance are
Yes.
taken from there and put into a little account, and the bank pays your
Escrows for you.
your escrows. Yeah. Great.
And then it also includes any title company fees.
Yeah.
But where I also go a little bit, I do a step further, is I'm the type of person that when I go buy something, I want to know, what's it going to cost me in taxes? Am I going to have to license this thing?
Yeah.
All the fees. I want to know what it's going to cost me completely. And so when I say that is there are some fees that they'll pay on the real estate side that don't really affect us on the lending side, but it's still a cost of the process. Like an inspection.
Yeah.
And then if you want to go a little bit farther down into that, you might get additional, like I know you've done additional testing on some properties.
I recommend it on all properties because, and so, when I'm telling somebody your inspection fees, it's around, I'm going to ballpark $500 for the home inspection, and that varies on the size of the house. But then like radon and sewer scopes. And methamphetamine tests, which people are like, methamphetamine? And I had 2 houses pop hot for meth in the last few years. So it is something that you need to be aware of, but it is costly. I mean, you're probably looking, I would say, between $1,000 and $1,500 inspections that are paid before you even buy the house.
Right.
To see if you want to keep the house, if you want to keep going through with it. And so those are important. And then appraisal.
Yeah, we've got appraisal fees. So right now, currently your appraisal fees are running between $625 up to $850, depending on if you're doing a VA jumbo, whatever product you're doing. And those costs, those get paid to a third party, and they're required to be paid up front.
Right.
So you have to pay that fee up front, and then we have your earnest money, which some lenders or loan officers don't even talk about the earnest money because they don't consider it part of the transaction, which that again is another whole other podcast. But it is part of the transaction, right?
Sure it is.
And so if you've got someone that has, let's say, $1,000 in the bank, and then they are doing a loan against their 401k and haven't applied for that loan yet, you're going to need to know, you typically earnest money is 1% of the purchase
That's what
price,
we usually
kind
see.
of across the board.
Yeah.
So if you're buying, $400,000 home and you need $4,000 earnest money and $3,000 of it's tied up in that 401k and $1,000 in the bank, you and I need to communicate, hey, let's do $1,000 now, and then within a certain amount of days, they'll do the other part.
Yeah.
But that's still part of the transaction.
Sure. And
even though it's credited.
Earnest money is credited back to you at the closing table. But yes, it is definitely something that you need to have up front, and that can be a shocker to some people.
Right.
So it's really important that they know that.
Very, very, yes, 100%.
Okay. So let's see. Where do people get surprised?
I think a lot of time the surprises come with knowing what the closing costs are.
Yeah.
I mean, we know everything's gotten a little bit more expensive these days, and fees have gone up and all of the things. And when, when you're doing the online things and it says, oh, how much am I going to need for closing? It doesn't take into consideration sometimes the lender fees and or maybe the closing fee, or if they're doing a traveling notary, like all those little pieces that come into the pie. I think that's where it really comes up. And I try to do my very, very best, my due diligence up front to say, hey, this is what you're going to pay. And if it's a little bit less at closing,
great.
Sweet.
Yeah.
Now you can go buy that couch you want, right?
Right. So if somebody's thinking about buying a $400,000 house, your recommendation to them is have 7%.
7% roughly.
Ready to go. Okay.
Yeah.
Awesome.
Yeah.
All right. So let's talk about tools and programs. So PMI, we talked about a little bit. It was a private mortgage insurance, and that's really for the benefit of the lender.
It's to protect the lender if the buyer goes into default.
Yeah. So it's important. And then let's talk about down payment assistance, because you did mention that briefly earlier.
Yeah. I love down payment assistance. And they have grants out there. Each county has their own grant or down payment assistance program. There's one that's across the board in Colorado that they give up to a 4% silent second. And I like this program just because it eases someone into home ownership, but then gives them the time frame to maybe build that equity. And because the silent second is recorded, so it does need to be paid off, either if you sell the home, it matures in 30 years, or you refinance. So we always have to take that into consideration when they sell the home and or if they decide to refinance.
Yeah. So somebody who says, "Oh, I'm only going to be here for 2 years," we might say maybe don't use that program because you need to have time to build the equity up.
Right.
And a few years ago that would have been 1 year, but in a normal market like we're in now, it takes a little bit longer.
Everything normalizes for sure. And they are income restricted, so we just have to make sure that they fall within that guideline. They do have several different programs that have different income limits. Sometimes they're by county, sometimes they're by where you're buying at, that kind of thing. So, and there's grants. There's programs out there that will give you a 1% to all the way up to a 3%. We actually have one that will do a 4% grant where you get the money. It does not have to be paid back. However, some programs may require that you have to stay in the property for a certain amount of time too.
And so, but the down payment assistance is not just for first-time home buyers either. So someone who's, buying another not a second home, but they've purchased a home in the past can still use that.
Yeah. So if I have someone that is selling a home and they're like, you know what, I want to use all of this money to pay off all of my debt. I don't want to put it towards another home. Then we can do the down payment assistance.
So let's talk about rate buy downs because some people know about them, some people don't, and they don't know to ask. And they don't know what to ask. And I'm thinking in particular, there's lenders out there that are saying, yes, our interest rates are this amount, and it's like a point less than what everyone else is talking about. And people don't realize they're paying for that. Yeah. So let's talk about that.
There's a hidden cost in there. So the buzz right now is going to be your buy down. You've got a permanent buy down, and then we've got the temporary buy downs, which I think is a big buzz right now too, because it does involve the seller participating in that. So a permanent buy down is when someone comes to me and says, I have $5,000 that I want to use to put towards my interest rate, and I want my interest rate to be low for my whole loan. And we'll price it out. And it's tough when people call me and say, well, what would that get me today? That's tough because pricing interest rates, it's not when someone calls me and says, hey, what are the interest rates today? I can tell them in general what the interest rate is doing, but I unfortunately cannot.
Well, we've got a little guest.
We do.
Murphy,
hello.
You need to leave.
Hi, buddy. We do have a little guest that came. Oh my gosh, if you could see him now, he's just checking the world out. Anyway, so a permanent buy down, when people ask me about interest rates, they come in and they say, hey, what can I get for $5,000? It's a tough thing to answer because pricing of mortgage rates, just like the stock market, it shifts and changes on a daily, sometimes hourly basis. I remember back during COVID, there were times that they actually locked us out of locking interest rates in because the market was moving so fast. So that's where you're going to get
Murphy,
that.
Hey, out. Go lay down, buddy. Oh, you can sit here with us. Okay, go ahead.
But the buy down, and it might not make sense for them. Sometimes if they have $5,000 extra, and I can only buy them down 1/8 of a point, it changed their payment maybe by $35 a month. Does that make sense?
Right.
No, probably keep it in your bank for an emergency. So we have those discussions. And then we have the temporary buy down.
Yes.
Temporary buy down. So at Supreme Lending, I do offer what we call the Payment Hero, where I do a 1-year buy down for people if they qualify for that. And so I'll do that right off the bat. But if we want to do something that's a little bit more aggressive and kind of ease them into the payment, we can do a 3-2-1 buy down, and then we can do a 2-1 buy down. And what that means is that, let's say your note rate is at 6.5. You would start out at, it goes 6, on a 3-2-1 buy down, you'd actually start out at 3.5, 4.5, 5.5, and then 6.5.
So each of those percentages you pay for
months.
1 year. Okay.
Those on that program, again, like I mentioned, we need seller participation, but that also we have to make sure it meets the concessions for the loan. And
because there's limits. So concessions is money that the seller can give to the buyer, and they can use for closing costs or whatever they need. But there are limits. Like a conventional is 6%.
No, it can be 3, 6, or 9 depending on down payment. So that's why on the 3-2-1 buy down, you cannot do it if you're only putting 5% down or less. So we could only do a 2-1 buy down.
I see.
So then that 2-1 buy down, same thing. You start out at 6.5 or 4.5, 5.5, 6.5, and it increments in 12 months.
Okay, great. Those are great. Okay, so let me ask you this: is private mortgage insurance, is it always bad? Because you'll have, great Aunt Susie telling you, it's terrible, don't do it. Is it always bad?
The challenge with private mortgage insurance is, again, it's one of those things that protects the lender. It protects the investor of the mortgage if someone goes into default on their loan. It doesn't protect the consumer. However, I will tell you, on conventional, with that type of loan, sometimes you get a better interest rate if you have private mortgage insurance, because it reassures the investor, hey, we've got private mortgage insurance on this end, so we're going to give them a little bit of an interest rate over the lifetime of the loan, right?
Yeah.
So the private mortgage insurance may not matter.
Right.
Yeah.
So let's talk about assumable loans, because we didn't mention that at all. And that's, you hear that a lot now because people locked in and got those interest rates that were 3%, 2.5% during the artificial rates during COVID.
Right.
And so there may be out there, those, so talk about that.
So we don't, on the Supreme lending side, we don't get involved in the assumability part of it. And the reason why I say that is if I were a buyer going to buy a home and there's an assumability option on there, you have to go back with the same lender and qualify through them.
Yeah.
However, I do get a lot of questions about them. And I've also been on the flip side where I've had a buyer who was selling their home. They let it go as an assumable loan. They're working that pain point, I would have to say, because they're very challenging to get done, and they do take some time.
Yes.
So it could affect that person purchasing a new home in that timely manner. But the challenge is that if you have a $500,000 home, like and the loan amount that you're assuming is $300,000.
Yep.
You have to come up with that $200,000.
And you can't get a loan for it.
You can't borrow the money because the investor that you're doing the assumability one, and on my end, I can't throw a home equity line on there.
Right.
Because you don't own the property yet, and you can't go to 100% financing on those.
Yeah.
So it's they're challenging.
So there are two loan types that are assumable. It's VA and FHA.
Right.
Conventional loans are not assumable.
No.
So the answer is, will it be right for you? The answer is maybe.
Yeah. I mean, it's a case-by-case basis,
right?
right?
So that's where an expert realtor can help you with that, and an expert loan officer can help you figure out that and see if it is a good option for you.
Well, and I think that's why we're so dynamic together, because if you do have a buyer that goes and looks at a house that's assumable, you're picking up the phone and you're calling me and saying, hey, what do I do in this scenario?
Yeah.
What are your experiences?
Yeah, because loans are not my I know enough to be dangerous, just like you know enough about real estate to be dangerous.
I know. I'm like, I don't know. Let's call Lisa. Lisa the lender, or Lisa the realtor, right? Yeah.
Well, awesome. So I think I hope that this show has given people an understanding of why it's really important to choose a competent lender who has a detailed understanding of loans and the underwriting of them, just in the same way that it's important to have a competent realtor that you're working with.
Well, and do your homework. You know, I mean, we are all looking at reviews right now. We're all Googling people. Google who you're working with.
That's actually something that I wanted to ask you about, and I forgot.
Yeah.
So let's talk about, a lot of people do like to do their homework, and they want to compare. They're going to shop it.
Right.
That's what we call it in-house. They're going to shop the loan.
Right.
And so it means they're going to call different lenders, and they're going to try to compare apples to apples.
It's challenging.
It's challenging.
In our world, I like to see, I'm the first one that I will do a comparison all day long because, again, like I said earlier, I like to know what I'm paying for, and I like to know where I'm saving pennies. Is it worth saving pennies? Maybe someone, where they may give a totally different interest rate, but what you don't know is you are actually paying for that. And if the seller is giving you a seller's concession, you're still paying for it. You know what I mean? Like it's part of the real estate transaction. So looking in that, and sometimes I'll get a fee sheet and I'm comparing apples to a banana or apples to an orange. Like it's not consistent. So I like to be able to look at that. So do your research, but then also have that person, like I can't, if you have an online lender, you can't send them a fee sheet and say, hey, can you look at this for me?
So do all lenders give clients a fee sheet when they've asked for a loan?
Not always.
Is that something that someone should ask for?
Yeah, you can always ask, okay, I'm paying $10,000 in closing costs. I want to know what's that $10,000 covering. And they should be able to. Sometimes lenders will say, hey, I can't give you a fee sheet until I get the contract. That's not always accurate. There's still a way to break down those costs and give the consumer the number.
So a fee sheet is the best way for someone to know what the cost of the loan is going to be.
Yeah.
Okay.
Definitely the breakdown.
All right, great.
Yeah.
So, but I think what's important is, if you've learned nothing, is you don't have to know everything.
Right.
That's what we're here for, is to give you our expertise and lend that to you and really make the best.
Yeah, we do this
clients.
every day. This is our thing. We do it every day. Yeah.
Yeah. So curiosity is allowed. Just call and ask, and we are happy to
help.
help talk through that. Even if it ends up not working out. Like that's, we're not in this, we're in this for the relationships. We're here to help people. And it, if it doesn't work out, it doesn't work out. That's fine. We're still friends.
Yeah, exactly.
So let me just ask you a few questions here as we wrap up. These are questions about you, so we get to know you a little bit better.
Yeah.
Coffee or tea?
Coffee.
Okay. And what's your favorite?
I love a dirty chai, and I know that that's probably going to create controversy on this podcast because that's not coffee, but it is because a dirty chai is espresso.
Okay.
And chai is tea.
Okay.
There you
awesome.
go.
So what is one of your favorite places to go in Colorado Springs?
Oh, gosh. I love Pikes Peak.
Yeah.
You get up there, and it's just quiet, and sometimes you drive a car, and then one time I decided to climb it.
Yeah.
And one and done.
One and done.
Yeah, started at 5 a.m. and I did it with an organization that was benefiting TBI victims. And if you're familiar with climbing 14ers, I was right in front of the sweep team with the oxygen tanks. And I'm born and raised here, so I thought I'd be fine with the altitude. And as you get to know me too, I was matchy in my cute little outfit. Well, didn't work out so well. The oxygen was right behind me. So
gotcha.
Yeah.
Okay, so I have one that I know the answer to this already, but I'm going to say Easter or Christmas.
Oh my goodness, Christmas all day long, every day.
Yes, I know you have a countdown probably before Halloween that you start.
Well, it actually starts November 1st.
Oh, does
because
it? Okay.
of I'm not allowed to do anything until Halloween.
Oh, okay.
And my household says no.
Gotcha.
Christmas music after Thanksgiving, but I can start being my little obnoxious self as of November 1st.
Got it. So what's one book or podcast that you have read or would recommend and listen to that you want to share?
So I try to read at least 6 self-help books a year. So I'll do a self-help book, and then I'll do like a fun, nonfiction or fiction, depending on what my mood is for that month. The Sprinkle Effect. Oh. If you could read this book, it gives you kind of some navigation of just changing your mindset. Changing one thing a day gives you a courage to do something else. So it's a great book. Plus it has sprinkles all over the cover. Like I'm all about the sprinkles. So yes, love that book. Yeah.
And I did want to mention, I realized I forgot, you've rebranded recently, and it's Loans Through Your Lenses, right?
Yes.
And why don't you explain to us why that is?
So as I've aged in life, I have to wear glasses now, and I've been wearing them for about 5 years, and I found this amazing glass company that you can actually change out the magnetic frames. And my husband makes fun of me because I have over 100 of them.
Yes, I've seen them.
Yes, and of course I have probably more Christmas than regular frames. But anyway, where I live, people have been recognizing me. They're like, "Oh my gosh, you're that lady with those lenses." And I've gone through some life-changing experiences in the last few years, and people are like, "How do you do it? Like, how's your jam? How do you get up in the morning?" And I'm like, what about doing life through your lenses? And then it transitioned a little bit more because as I meet clients, as you and I see each other all the time, I'm having a different frame of glasses on. And I was like, why not loans through your lenses?
Yeah.
So I'm launching a new logo as of January 1 that's going to be just giving insight to different loans from my point of view and how challenging or not challenging or So I'm excited about it.
That's good.
Very excited about it.
Okay, well, Lisa, thank you so much for your time and sharing and educating people. If you are thinking about buying or selling in the next 3 to 6 months and you need a lender to help you with that, Lisa Gaimara at Supreme Lending, Loans Through Your Lenses is the way to go.
Yes.
And if you are moving to or in the Colorado Springs area, I would be happy to help you. Lisa Pflugh at Tava Homes Group at Remax Properties. Thanks for listening to The Fine Print with Lisa Pflugh. I hope today's conversation gave you something to think about. Feel free to share this episode with someone else navigating a similar situation or who is making real estate decisions. If you're exploring your next move, have questions about real estate, or want to learn more about today's topic, I'm here to help. Visit tavahomesgroup.com/The Fine Print or text me directly at 719-602-1172. And if this episode was helpful, I'd be grateful if you would leave a review or share it. It really does help others find the show. Until next time, take care. And remember, in real estate and in life, the details matter.